Make a plan and stick to it. That is the best way to execute in any business, really. Pivot as markets change, but don't be like, oh, I'm buying, apartment buildings and doing long-term holds, and now I'm doing Airbnbs down the Jersey Shore because I saw a YouTube video about it, or I read a headline about it. Like, no, I know someone that's my friend's making money doing it. Over time, sure, as you become successful in one space, you can branch out and try new things. But the greatest people just focus on one business plan and stick to it.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I'm so glad you're here with us again today. I've got another amazing guest. I know I say that all the time, but I've got the NJREN Fragnito. Aaron, welcome to the show.
Jeremy, so glad to be here, my friend. Thanks for having me.
Yeah, absolutely. Looking forward to chopping it up with you. Aaron is a full-time real estate investor with a primary focus on helping accredited investors, family offices, and RIAs preserve their wealth in real estate. Aaron has built an 8-figure real estate portfolio in the New Jersey area and is well known throughout New Jersey in that investment community. Aaron, I'm not doing your bio much justice here, so would love for you to spend the next few minutes telling our listeners a little bit more about Aaron, your journey, what you're focused on today, etc.
Sure, Jeremy. Yeah, thanks for having me on the show here. I love doing these podcasts. I have my own show as well. And I got started in real estate in 2010 as a realtor. And it was just a dismal market. I was forced to learn short sales and foreclosure properties because you really weren't selling regular old houses as a realtor. But I had read a course called Rich Dad, Poor Dad, the Bible of real estate investing. And in 2009, my senior year of college, as I was facing, the worst economy to graduate into in generations. And, I want to own a real estate investment company. And so I made a list, and at the top, I want to have a net worth of $1 million and $100,000 of passive income from my holdings over a 10-year period. That was a 10-year goal. Kind of worked down from that. I said, okay, I got to learn the industry, make connections, save some money, meet partners, and said, okay, I'm going to go get my real estate license. So I lived in Jersey, grew up in Jersey, and got my real estate license, started selling houses there and learning the short sales and the foreclosures and flipping houses, and teamed up with my business partner today, Seth Martinez, and started People's Capital Group around 2013. After cycling through some partners that were not as honest and as good a fit, and ended up stealing money from operating accounts and things like that, had the whole, all the challenges there of just aligning with the wrong partners. So I learned that pretty quickly. And got into flipping houses, just started buying small buildings, started with like a 6-family in Newark, a 5-family in Newark. I used to staple "We Buy Houses" signs to telephone poles in the hot sun of August in a suit and tie for some reason. And that's how I got a lot of our first deals. And we started a real estate networking group called New Jersey Real Estate Network. We have about 5,000 members in that today. And start raising capital, start talking at different RIAs. And before I even really knew what I was talking about, I would go out and speak at these RIAs and talk about what we're doing and the short sales and the multifamily properties. And, Seth had sold a medical billing company. So he was liquid and I had deals. I had deal flow. I was the realtor. So I was the deal guy, the sales guy, kind of the public speaker. He was operations and good at managing these assets and repositioning them. And then over a year or two, we refinanced our money back out. I remember the first 6-family I bought, spruced it up, leased it out, did the BRRRR before there was a cool Gen Z term for it, and got our money back in about a year, and paid back our private investors. And we said, there's a light bulb went off. Said, wait, we can do this. We can recycle capital, continue to build a portfolio, get bigger and bigger assets over time, and a lot of growing pains. Hired and fired the wrong management companies. One was stealing money from us. Went through about two of them before we realized we need to develop our own management company, really have our own boots on the ground and do this the right way, and became vertically integrated starting in 2015. But that was challenging, building a good management company, not just a company that collects the rent and calls a plumber when a pipe leaks, but actually repositions mismanaged, distressed assets and refurbishes them and leases them up and so on, was hard. And we still work at that every single day. But just sourced a lot of great deals through the years and got more into the syndication space 2019. Yeah, I just wish I kind of learned how to raise capital sooner on a large scale, but that's been the pinnacle of my career. Now we work with family offices, high net worth individuals. We're speaking with different fund of funds and institutional level investment groups as well, and just kind of working to put together larger capital stacks and acquire larger assets. And that's what we're focused on right now, but strictly in North Jersey, everything within an hour commute to Manhattan. We stick to what we know. We buy in a very specific market here. We know how to manage very well here. And that is our recipe for success.
Yeah, no, I appreciate that, Aaron. And wow, if I was to give somebody a PhD in real estate, I'd probably hand you the certificate. I don't know if such a thing exists. Usually those PhDs are learned, through blood, sweat, tears, and grinding. And it sounds to me like you've had, your fair share of successes, and failures over the course of the last decade that you've been in the space.
Oh, yeah. We've done about 300 transactions here in New Jersey, small deals. I flipped land, I flipped houses, I bought apartment buildings, the whole thing, commercial, residential. So, yeah, absolutely. And there were definitely some losers in there. There's no doubt about it, which I learned so much more. I couldn't even tell you like most of the deals I've done that I made money on, maybe a few of them, right? But like for the most part, man, I do not forget those losers. In fact, I'll like write on the wall, never forget, this one, because those lessons you learn from a loss are so much more important than what you learn from a gain.
Yeah, absolutely. And I think somebody said once at some point that we actually remember our losses a lot more than we remember our wins. So appreciate you highlighting that. I'd really like to talk. I know that you and I are both big proponents of, attracting, higher net worth individuals and having them invest passively, into our deals and opportunities. But let's talk specifically about that investor out there that wants to get into real estate on the active side. Okay. You and I both have fixed and flipped houses. We've both had, a portfolio of single family homes, and we've kind of, cut our teeth right early on. What would be maybe one of those biggest one or two pieces of advice, that you'd give that individual that's out there right now that wants to actively own real estate, and maybe they're deciding, to Airbnb something, fix and flip something, wholesale something? Like, what would be the one or two different pieces of advice that you'd give that person as they get started?
I would say, and this is from my own mistakes as well, create a plan and stick to it. When we first, Seth Martinez and I launched People's Capital Group, our plan was to get 1,000 units in 3 years. And we bought a 25 unit and raised capital. We were successful in that. And then we went to buy another 25 unit and realized when you start raising outside of friends and family, it gets a lot harder. So instead of really learning capital raising, we just started flipping houses and kind of shifting gears. Now, looking back now, it gave me a breadth of experience and allowed me to kind of do what I do now. But if we had stuck to the original plan, we'd be up there with some of the greats, like some of the groups you work with over there at Rise 48, whatnot. So, and I remember we were getting started right around the time Joe Fairless with Ashcroft Capital was getting going, and we were like reading his books, so we should have just stuck to the plan. And so stick to the plan, make a plan and stick to it. That is the best way to execute in any business, really. If you're going to buy, 6 to 12 units in this part of this, do it effective. You're going to do Airbnb and be the best at that. Learn your space, replicate, improve, look at the best people in that space and replicate what they're doing. Put your own twist on it, put your own brand on it. But the people that are really successful in that space you want to be in, learn what they're doing and do it just as well with your own twist on it. And stick to the plan, keep persevering through challenges, pivot as markets change, but don't be like, oh, I'm buying, apartment buildings and doing long-term holds, and now I'm doing Airbnbs down the Jersey Shore because I saw a YouTube video about it, or I read a headline about it. Like, or I know someone that's my friend's making money doing it. Over time, sure, as you become successful in one space, you can branch out and try new things. But the greatest people just focus on one business plan and stick to it.
Makes total sense. And I'm totally flattered based upon what you just said. So thank you, Aaron.
Yes, absolutely. Absolutely.
No, but it's interesting that you highlight, and one of the things that you kind of alluded to or mentioned, is this concept of having a mentor, right? I think if you're going to get into active real estate ownership, it's not just reading the books and listening to the podcasts and, sticking to your boring buy box and resisting the shiny, object syndrome, but it's also finding somebody that maybe has been there, done that, right? Find somebody that got in the space 5 years ago, find somebody that got in the space 15 years ago, right? Because they're going to be really able to help, guide you, on that and through that journey. But you have to be able to provide them something in return, right? So find something, that you're able to offer in exchange for that, coaching and that mentorship, and helping really you to avoid some of the common pitfalls that a lot of folks are making in the space. I would argue the same thing now can be true for the passive investor, right? Which you and I both educate a lot of folks on. So somebody that's maybe new to passive real estate investing, how do you explain the key benefits of passive real estate investing over traditional investment strategies like the financial advisors are telling us to get into that are all centered around Wall Street investing?
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Yeah, absolutely. Well, I speak with passive investors every single day, Jeremy, and I find it incredible. A lot of investors say, oh, I want to avoid risk, so I'm going to keep all my money in the stock market. And so we have this mentality, and I had it too, that investing in alternative investments are more risky. But then, Jeremy, I started speaking with extremely wealthy people, family offices with a net worth of $250 million or more. And what I found was they had a completely different understanding of wealth, preservation, and wealth growth. And they were about 60% to even 80% in alternatives. And in fact, the minority of their investments were in mutual funds, like how most of us hardworking W-2 earners invest. And so what I found was the real true wealthy, like beyond, the high net worth individual, is actually investing with a completely different mindset. And what that told me was investing in alternatives where you can make, we're targeting 20% IRRs on a lot of our repositionings of Class C to Class B buildings. You see all types of incredible targets out there and achievements with investment groups, and you're just not going to earn that year over year in a mutual fund. Now, you want to be diversified. You want to have some money in the stock market, in the bond market, and be a well-diversified investor. But I just find it hilarious that most of us are taught, and I was the same way, that you want to have all your money packed away in a mutual fund. That's the safest place for it to be. And then a lot of those investors, when the market dips, they panic and they sell, which is actually the wrong way to invest in the stock. You want to be buying when the market dips. When it dipped a few weeks ago, when the tariffs were being announced and so on, and I knew people dumped their stock. I'm like, what are you doing? If you don't sell, you don't lose anything. That's the time to buy. Take your dry powder and buy. So, and that's the mindset, though, of the ultra wealthy, is invest in alternatives. They offer tax advantages that are far greater than stock investments. Real estate is one of the most tax-advantaged asset class. 60% of billionaires' wealth is held in real estate because of the tax advantages, cost segregation studies, bonus depreciation, 1031 exchanges. These are amazing tools you can use to keep more of your money and give it less to to the IRS, where the majority of us hardworking individuals say, you know what, I'll take 10%, I'll put it in here, maybe invest through a Roth IRA or an IRA, and that's a great strategy as well. But man, we need to completely change our investment strategies. If we want to be the ultra wealthy, then you need to invest like the ultra wealthy. And that means investing passively, hiring professionals to invest your capital. Because I also see another thing that investors do is they say, I work 60 hours being a doctor or being a C-suite executive, and I'm really good at what I do. And I make $500,000 a year doing this. And I'm excellent. I went to school for it, I say, that's amazing. Do not quit what you're doing. You're a great doctor. You're a great C-suite executive. You're a great CFO. Keep doing what you're doing. And you're extremely successful in your space, but take as much as you can and don't overbuild if you make 500 grand a year, don't build a lifestyle that costs $501,000 a year. Cause I've seen that too. Create a lifestyle that costs $250,000 a year and enjoy life. And then use, take 100,000 a year and put it into alternative investments that create a great tax advantage and do it in a wise, diversified way with good operators, not the guys promising the biggest returns or the highest pref and everything. Don't go chasing returns. Chase operators, good operators that sometimes are a little bit under the radar, and have good systems in place and a proven track record. Diversify over a number of projects. Don't put all your eggs in one basket. And that's how I see the most wealthy individuals multiply their wealth. I've helped people take $100,000 IRA and turn into $300,000, $400,000, $500,000 through the years by investing wisely, or just a high net worth individual that was having trouble keeping up with their lifestyle costs and now putting 50 grand here, 100 grand there, planting little seeds in different projects with us and being able to multiply those investments over time. They put 50 in, they come out with 100, they roll it into another one. They put 100 in that one. Then now it comes out, it's 200. Now they put 200 in, now it's 400. Every time we're doubling it, that's always our goal. And, that is how wealthy people become more wealthy and preserve their wealth too.
No, I appreciate you saying that. And I am that person that you're describing, having gotten into my first real estate syndication as a limited partner investor almost a decade ago now, and having now been in 40 deals as a limited partner investor, having had some full cycle exits, having plenty of deals that, have had cash out refinancers or supplemental loans, which resulted in a return of capital. So I've kind of seen the full gamut and can tell you you're exactly right. I mean, really what passive investors are doing is they're leveraging somebody else's time, experience, their track record, their knowledge of the space, right? And really, you don't get rich in this game overnight, but you can in a 5 to 10 year period really start to change that wealth building trajectory. And you mentioned, I guess I'll call it the eighth wonder of the world, and that's compounding, right? And it's amazing what happens when, an investor, stacks, 50K, 100K investments on top of each other and staggers them, ladders them, over the course of a 5 to 10 year period. It's amazing what can happen, when it comes to wealth building. But you did mention wealth preservation. So I did want to highlight that for a minute. How is it that People's Capital, underwrites deals differently when the goal is wealth preservation versus maybe a more aggressive growth strategy?
Sure. Well, the first thing we do is you want to make your money when you buy. So we look at a lot of deals, and the word no makes you more money than the word yes in real estate. So I'll start with, say, 100 deals over a 6-month period, even 12-month period, right? We might buy one building a year, sometimes depending on the market, especially a couple of years ago when deals were, few and far between. Now we're seeing better deal flow, I'd say, better prices for sure, better cap rates. So the first thing we do is we underwrite very conservatively, and we make conservative offers, and we do a large amount of due diligence. If you're doing your due diligence right, you're gonna kill a lot of deals in the due diligence stage. Now obviously you want it, when you're buying older buildings, fixer uppers, whatever. mismanaged assets, you got to take them with a grain of salt and have those allocations in place for renovations and so on and improved management. But we underwrite very conservatively. We complete our due diligence in depth. And then when we acquire the asset, we have in-house management to manage it very efficiently, but we also do a cost segregation study. So we're going to take full advantage of the tax code, and we're going to front load that tax depreciation through a tax study, essentially, it's done on the property, which generally makes sense for any property 2 million or more. And that allows investors to take something called bonus depreciation, which essentially is just taking as much tax depreciation as you can in the year you purchase the property. And so that allows investors generally to get about a 20, right now, if the tax law stays the same, it's about a 25% tax write-off on their investment. So if you invest $100,000 into one of our opportunities in the year 2025, you'd expect about a $25,000 tax write-off in the year 2025 as a passive tax write-off. So that helps investors write off passive gains as well and future cash flow on the asset. And then the second thing we do is we also, when we do exit a property, okay, because right now we're doing a 5-year plan with our investments. So we buy, we reposition, we tend to refinance over about a 3 to 3.5 year period. And then we target to sell over about a 5-year period. Now, when you sell, you do have capital gains tax and tax depreciation recapture. So what we do is we aim to buy another asset in that same calendar year. And we offer something called the lazy 1031, where you can roll you take your money back, you take your profit back, and you invest in another deal in that same calendar year. And we do a cost segregation study on that next deal, and we front load that tax depreciation. And you use that big new tax write-off to write off your gains on the previous exit. So you're just rolling your investment into another deal. You're taking a big tax write-off on the new deal. You're writing off the gains on the old deal, and that allows you to essentially write off your gains and pay, ideally, if you do it right, no capital gains tax, and multiply your investment into the next deal there. And then, of course, rinse and repeat. And keep doing it. Keep front loading that tax depreciation. Every time you exit, you get into a new deal in the same calendar year. And by doing that, you essentially can pay zero capital gains tax and zero, especially if the cash flow, like on North Jersey, it's kind of light. Like 85% of the return is actually realized through the refinance and the sale. A smaller amounts realized through cash flow. And because of that, we can essentially create a completely tax-free or tax-advantaged investment opportunity for investors. And that's why when we talk to super wealthy individuals, they're all mostly invested in real estate. Because if you sell a stock and you have capital gains tax from a stock and you buy another stock, you can't do a cost segregation study on a stock. You can't front load 25% tax free. The tax advantages of real estate are just incredible. So if you understand how to execute them, and by the way, to our investors say, okay, I want to do this buying a 3-family or something, the cost segregation study, the cost of it, the study itself, outweighs the tax benefits of it, unless you're buying like over a $2 or $3 million building, depending on the laws and the bonus depreciation laws and where they're at. So what happens is for investors that are limited, maybe you put down $200,000, you buy a $600,000 building, it's great. But you can't really take full advantage of the tax code doing that. When you get into a $5 or $10 or $20 million building and these operators are doing a cost segregation study and front loading that tax depreciation, then it makes sense. Then the cost of the study does not outweigh the benefits. The benefits far outweigh the cost. So by investing passively in larger opportunities, you get to take full advantage of the tax code, where if you're a one-off guy trying to make your own way, buying smaller deals, there's some advantages to that. For the most part, being an active landlord stinks. I hate tenants, toilets, and trash. I've delegated that to a great team that have far more patience than me and are willing to work weekends and late nights, where that's a tough part. Man, I do not want to go back to 2013 Aaron, getting the calls and the this and that. I hated that. I was like, wow, this is for the birds. So being an active landlord is not particularly fun. Being a property manager is the least fun part of property ownership. And that's why people invest passively, to continue to build their wealth, spend their time with their family, do the things they love, and take advantage of the tax code.
Yeah, makes total sense, Aaron. I really appreciate the breakdown there. And you brought up the lazy 1031. I just wanted to highlight, one thing as well, and that is a lot of operators in the space won't allow you to execute a traditional 1031 exchange unless you're bringing in a check size of, in some cases, 500K, in some cases, $1 million or more, just because of the headache and the heartburn associated with the legal and tax implications, of the 1031 exchange. But the lazy 1031 exchange is a great, avenue for those, what I would say smaller investment sizes, those investors that are, rolling 50K or 100K, plus their equity profit split into another deal within that same calendar year. They can effectively achieve, it's not the same, but they can effectively achieve, a similar result, by executing that lazy 1031 exchange, versus the traditional one. And then aside from that, if you're taking our advice, and that is, compounding dollar cost averaging, continuing to stay in real estate, tax advantages is not why I got into real estate, but it's why I can't get out, right? So if you're investing in enough deals, over time, you're always going to have enough or a sufficient amount of passive depreciation loss activity to offset, any future exit. So really appreciate that breakdown.
Yeah, absolutely. And if you work it out through a life cycle of 5 or 10 investments, I mean, it's an exponential growth, right? Because you think about it, if you invest 100 grand and you're walking away with 200 grand, but you have to give 25,000 of that, to the IRS. So now your next investment's only 175,000, and then that. But now if you do the cost, like if you take full advantage of the tax code and your next investment's 200,000, you're getting another 25 grand worth of ownership in that property. And then that's multiplied times 2x. And then the next one's 2x. It's an exponential advantage to utilizing that.
Well, this has been a tremendous conversation, Aaron. What would maybe be one or two different ways that our listening audience can connect with you to learn more about what you're up to?
Yeah, sure, Jeremy. So our website is peoplescapitalgroup.com. And we also have a networking group called New Jersey Real Estate Network on meetup.com. We have in-person events here in New Jersey. We have one at the end of June in Somerset, New Jersey, and the Jersey Cyclone Brewery. We'll give you a free beer if you show up. And we also do one in Jersey City to kick off the year at the 902 Brewery and Company there in January. We also do investor walkthroughs of our buildings. We generally buy 1 to 2 apartment buildings per year that are for accredited investors there, repositioning vintage real estate here in northern New Jersey. Most of our investors are in the tri-state area because we're so specialized here in Jersey, but we have investors all over the country. And I also have my own podcast there, the Passive Cash Flow Podcast. So that's on Spotify, iTunes, all major platforms, YouTube as well. So we have about 180 episodes like yourself here on the Passive Cash Flow Podcast. And so, yeah, that's where we're at, peoplescapitalgroup.com. We have, ebooks and all the free content there. We don't sell anything. It's just a bunch of free content about real estate investing. We're on YouTube there also. But yeah, it's come visit us over here in Somerville, New Jersey, People's Capital Group.
Well, Aaron, again, really appreciate you joining us on the show and the tremendous value that you brought our audience.
Thanks, Jeremy.
And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.